All right. Well, guys, thanks so much for joining today. Really appreciate that you guys take the time to oh, I saw a few people that need to be admitted. I don't know how to do that automatically. All right, I think everybody's in now. Are you guys able to see if somebody's in like the waiting room that needs to be admitted?
I don't think so.
Sorry, Ben, I kept jumping in and out there for a second trying to get my computer to work.
No worries. Yeah, I'm gonna after this meeting, I think I'll figure out if there's a way to have everybody just like kind of admit automatically in case I'm not looking. I don't want to miss somebody. All right, so thanks for joining. I think you guys know where to find me. I've got the Substack, and then I'll put all kinds of charts and stupid shit out onto X throughout the week, and as things appear to me. Um, the I like to throw a quote in here. This one's pretty timely from Larry Williams. If you have you guys seen any of Larry Williams' work? He's got he and another gentleman won the Dow Award last year for an indicator that a couple of indicators that we'll take a look at that are on my part of my top 10 for market timing. But I think this is pretty well timed. So, we're seeing like a some pretty extreme sentiment in the market, and sentiment like you get the AAII Bulls Bears survey, and you see these things kind of like shift to extremes. But at the extremes, sentiment works well, but when we're in the middle of a trend, it's kind of hard to read. So we're going to need to see the market, choose a bottom and then pick a direction, and then measure sentiment from there. So it'll be probably pretty confusing until this all irons out. Taking a look at the top 10 indicators that we use for market timing, this is the worst that I've seen it. And look back historically at the number of times that there are 10 here, and I've got I think six of them fully back tested, and the others I need to see if I have enough data points to line them up. But so they're back tested in the sense that we know what the outcomes are, but in terms of like recording each of the dates of their occurrence, and doing like the peak to trough analysis of each of them, and trying to understand when they occur together, things like that. I'm trying to see if there are combinations of them that are a bit more revealing than others. But so of like the six that I have all of the dates recorded, there's only about eight times that I've got between four and five of them active at once, and this is quite a bit of them active. In some of those cases, I think Derek reached out to me the other night. In some of these cases, that when we have this many triggering at once, we're pretty close to the bottom of a move. So that's potential that we see this many extreme readings in the market all come in at one time, that we could be pretty far into that type of move. In some of those cases, there was a lot further to go. So actually, I'm just going to take a peek at it real quick. Yeah, so looking at the times that we had either four or five signals active at one time. I'll share that screen. So it's a little small, but so just looking at the times that we had either four or five signals active at one time, um, there you've got.
Ben, we're still on weight of evidence. Did you switch over? Or?
Oh, did it switch for me? There we go. All right, there we go.
There we go. Thank you.
Yeah, thanks for let me know if let me know if that happens, because the screen's just too large. It's like one of these like 4-foot monitors, so if I just share the whole screen, it's It'll be like a stripe. But so looking at the number of times that we had either 4 or 5 signals like these active at one time, half of the instances we were relatively close to the bottom, and then the other half, are pretty bad. Like there was like another 20 to 40% drawdown from signal to low. So I'm not saying it's hard to look at that and make a judgment as to what this outcome is. What's most important to me right now is to just know that we've got these signals active, and that we want to use trend and some technical indicators to try to understand where the market's finding a bottom. Any questions about the weight of evidence approach? We'll go through them like individually. We'll tab through, but just for anybody that might not have seen them before. So this was an update in Martin Pring's report this past month, and so he looks at the stages. So you've got like the economy versus the market, and so the economy is still in an expansion, even though the market doesn't seem awesome today or any of this week. But so the economy is expanding. The market will bottom before the economy does, and so the last time that he had the report published, we were in stage 3, where it's time to accumulate inflation sensitive equities, and then as the Fed starts cutting rates and the economy starts to get into a peak and roll over, the inflation sensitive are sold in like the latest stage. But so right now, treasuries are taking off. It's a flight to safety, and this isn't imminent, but this is our opportunity to start to sell bonds and exit the treasury positions as those start to peak. And the asset classes will peak in the order of treasuries and bonds typically peak. Then you have and they roll over. Then equities have their final push. It might be a higher high, it might be a lower high, but equities will make their final move. Then you'll see commodities take off for a while. Then it'll roll over to everything will be focused on the U.S. dollar demand, and then the cycle starts over. So this is a notable shift to move from stage 3 to stage 4, and that should tell us to expect a regime change. And this will be the last stage where we want to consider adding to equity positions, because the next 2 stages will, so we want to do this really thoughtfully, carefully, only the things that we have the most conviction for, because once we get into stage 5 and stage 6, that's when we really want to do our selling. Obviously not today and yesterday. We want to sell in advance of drawdowns. Interesting note from Milton Berg. Milton's like he's a bit bearish for me a lot of the times, but he's been around and successful for a long time. Aaron in the Total Growth Investing group has done some work on margin debt, and this is a bit different of a look at it. So he's looking at the ratio of margin debt to credit balances, and so we're starting to see that the panic selling, but real panic selling doesn't start until margin is liquidated, and so if margin is still relatively high, then there's still a lot more risk in the marketplace.
Okay, Rosie?
Total growth, they have another
Oh,
total growth.
And then if I'm a big fan of Tom McClellan's work. His dad has a recent interview with the Cycles Foundation on YouTube. If you guys want to look that up, he goes through the the history and the background of the McClellan Summation Index and McClellan Oscillator that use combinations of new highs and new lows to help with market timing. It's a pretty interesting approach, but it's a lot of indicators. You look for crossovers or above and below zero with the McClellan indicators. It's important to look at like the shape of the trend line, almost like you would a price chart. And so it's a really good session. If you guys have a chance to check that out. But he was referencing an article about gold, and I hadn't realized that as gold was going up, there was a lot of gold bullion that was being transported back and forth. And so much so that in the US, we had to do a gold adjusted GDP. And I was curious why the Fed now GDP forecast had a gold adjusted line on it, but it's because of how much gold was being moved was actually distorting GDP readings. So it's interesting that there's that much of it moving, and now that it's been used as a hedge for the tariffs. Now that the tariffs are known, it's likely that we'll start to see gold start to roll over. And so if you have gold positions, it's not to say that gold is going to bottom or something, but it's probably an opportune time to take some profits there. And a move in gold typically precedes a move in commodities by as much as like 18 months to 2 years. So what happens is if we think about things that are a hedge, we're hedging for an event that we expect. So if we're expecting prices to go up and we're using gold as a hedge against that, then once those prices go up, we either no longer need the gold, and we're going to move on to another asset that we want to speculate on, or we're actually going to use that gold to offset the price increases. And so it has to be it has to go back into like a distribution mode after accumulation. So the risk there is that after a lengthy run up of gold, it may not move like an equity does or like a crypto where it comes down, tests support, and then shoots back up. It might be a much slower drawdown. And actually, I'm going to share while we're talking about gold, I'm going to share a gold chart real quick. Just bear with me while I set it up. So we've got this Costco, but so if you've been in dividend groups before, we know that the yield chasers come in the very last in the world to come up with an idea, right, for a new equity or new asset class to go into. And so this is the GLDI covered call ETF for gold. And the last time, I'll actually compare it to gold itself. So the last time that GLDI, makes it a little bit hard to see. Yeah, the last time that GLDI made a new high, it was after gold peaked. So we can see it, it comes in here, it makes its new high about like that's August 2020. And so like 2 weeks after gold peaked, gold the commodity, then this GLDI covered call ETF had its wick high, and that's into the anchored VWAP from 2013. So it's test this VWAP, and then it fails right at that VWAP, and you can see it came very close to testing it when gold was making its run up in 2020, and then actually does test it and fails, and so that makes it an ideal place to anchor a new VWAP. And so if it's going to go on and challenge a prior high or make a much larger move, it's going to have to battle through that anchored VWAP first. So there might still be another move here if gold does do a retest of support. But this is telling me that there's a potential that we also have an incomplete move. And that the yield chasers are going to help identify that for us. So we've got a case for an inverted head and shoulders. The measured range would send it up to, about the 173 range, which lines up with the consolidation of volume in the volume profile and a technical level. So it's, in between the 1.272 and near the 0.68 from prior retraces. So that's where we would expect like a measured move to be forecasted out of an inverted head and shoulders. But if it fails at this anchored VWAP, then it's likely that we see failed bullish moves become strong bearish moves, and that could send it down to back down to 142, which lines up with a dense area of volume down below. So you've got like kind of two targets for it, but the short version of the story is that the yield group came in and likely found a local top for gold for us, and so that aligns with with the narrative that Tom McClellan was identifying for us too. And then we'll look at this a little bit, but I referenced the sentiment cycle quite. Did the screen update? No.
Yeah.
Okay, there it is. Yeah. So I reference this quite a bit, but we'll see this sentiment cycle everywhere. It shows up on multiple time frames. It's almost impossible to miss once you really get an eye for it. And so the types of things that we're going to be looking for as the market continues this move lower is, are we really in the despair phase? So if we're in the despair phase, then we would have already seen panic like a few days ago. And it doesn't feel like we saw like a real panicked move until recently. So you've got these, this cascading series of candles down, some gaps down. You'll have an open that's lower than the prior day's close, and then you start to see these wicks down lower and lower, a lower lash underneath your candle like this is going to start to tell us that the selling is getting exhausted. And once you get like a real low wick low, and then a close pretty far above that low, that's telling us that buyers are starting to step in and the sellers are starting to exhaust and get concerned that they're that they're missing a low of a market. And then you get this little back and forth phase. This is what Larry Williams is talking about, where it's the sentiment is less predictable because the market hasn't made a decisive move. So the market will start to climb back up. It'll get worried that that it's that the downward move is not over yet. It'll pop back down into aversion, and then really the safest thing for us to do is look for a sentiment of denial where the market has started to climb back up and nobody believes it, right? So some things that you might see there, if you're on a lot of social media, you notice like I've got my own strong political beliefs, but I'm generally not a fan of either political party in the U.S. But there's there were a lot of angry posts about the price of eggs. The price of eggs have come down, and we're just not seeing any posts about eggs now, right? Like nobody's really talking about how eggs are cheaper. We're going to start to see that with the market, right? Where everybody's had a really good time posting about how the market's tanked underneath the current political administration. And then it'll just like quietly, nobody's going to be acknowledging the fact that it's recovering. And they might even still be referring to the market as if it's going down. So that's what we want to be on the lookout for is denial. That'll be the safest place for us to step back in. It's much riskier to try to, jump into things during a despair and an aversion stage. If we were able to time it, it's the best value. But you can see once we get into denial and start to climb, there's a really strong business case here, for an entry, and you can set your stop up, kind of low or really tightly. So it's this is the best risk reward is to wait for the market to reach denial. So that will take a look at a few of the charts. And So trend wise, man, this is ugly. Like so the S&P is below every moving average. Every moving average is below the next, with the exception of the 50-day EMA is above the 200, thank God. But that's pretty ugly in terms of the number of days down. So this is an oscillator that looks at the percentage of the last 9 days that are up or down. It's actually not it's not a great bottoming signal, but it tells us when things are getting exhausted or fatigued. And we had a series of up days in between here. So that's a signal that, you know, we've seen a lot of selling, but it might not actually be fatigued yet. Looking at the asset classes, so you've got treasuries are now showing the most strength, right? And so this is an asset class transition where we will expect treasuries to show the most strength and roll over, then a handoff to equities where equities make a final push. Gold is in the middle, but you know, we're typically looking at treasuries, equities, then commodities, then the US dollar index. And so gold precedes the move in commodities. Commodities are picking up a little bit of strength in the short term and in the long term, but they're still relatively weak. And the US dollar is weak in the shorter time frame and intermediate time frame. And it looks like the only things ripping up into the green are the VIX and the VIX of the VIX. So definitely not a fun time in the market right now. Taking a look at the VIX, so we now have a higher high in the VIX, and our Keltner band and VIX, so the upper band of the Keltner channel and the VIX are screaming up to new highs. And we're between 30 and 45. And so that's the significance of that. I'm just going to extend the regression channels. The significance of us, and here we can see the S&P is breaking below the lower band of the regression channel intraday. And we haven't seen that since October 2023, which was a low. So yeah, breaking below a regression band, like a downside channel breakout, could be, you know, a shift into a downtrend where we'll start a new a new trend, or it'll recover like it did in 2023. So that's what we'll have to watch for. Now, when we look at the VIX, you know, breaking out to this level, so let's shift that to a line graph. Oh, I can't on this one, sorry. So when we look at it breaking out to this level, this VIX indicator is looking at instances where it breaks above 30, and that's a risk event. And once it goes up into these levels, like the 30 to 45, and then reverses back below 30, that's a temporary mean reversion. And these are actually pretty nice buying opportunities. So, so if we see the VIX close below 30 after this rapid run up, that should be good for like a 5, possibly 10% move in the S&P, and it'll be relatively quick. It doesn't necessarily mean that we've seen the bottom. So if we happen to be walking into a bear market, then you know the types of things that we can see are a stair stepping down. And bear market rallies can be really, really steep and profitable, but they're very high risk. So so if we do see this, VIX move back below 30, that's a great opportunity to for a swing trade if that's what anybody is comfortable with. Again, none of this is financial advice. It's just things that I see and do. If they're a fit for anybody else, that's that's really good. But definitely not something I would recommend for the faint of heart. This is Andrew Thrasher's 5% drawdown risk indicator, and obviously they're all confirmed at this point. So this is not much new information on this one. Here we've got the 200-day moving average the percentage of S&P companies uh, that are below their 200-day moving average, and this is pretty high. So once we get into like, 80% of companies in their 200-day moving average, I'm sorry, once we get to like about 80% of S&P companies below their 200-day moving average, then we're probably getting into like the getting pretty close to the bottom. You can see the market.
Can it be clean?
Or, be-
I can wash and put it back.
or bed?
Yes.
Yeah.
You wanted me to wash?
No.
Oh, she did it?
I think she did it, yeah.
How you know?
So I think I saw her do it.
Oh.
David, I'm gonna mute you real quick. The sorry, I thought that was a question for me. So when we see the number of companies in the S&P that are below their 200-day moving average get up to about 80%, that's typically really close to the bottom, but again, might not actually be the bottom. So we have to be careful with that one. And one thing that we were looking at the other day is Coca-Cola was one of 19 companies that made a new all-time high yesterday. And so I was curious, like, the market's like really taking a shit right now. When was the last time, how often does that happen where the market looks awful and Coke is making a new all-time high? So we've got about 8 times where Coke made a new all-time high while the number of companies in the S&P below their 200-day moving average was getting close to the 80%, like between 75 and 80%. And you can see the S&P is in teal. That was typically pretty bad news for the S&P if a consumer staple like Coca-Cola that's been around for a long time, not a real volatile stock. If we see that making a brand new high with the number of companies in the S&P getting to this below their 200-day, getting to this 80% range, 75 to 80, that seems like it's a pretty decent risk indicator. So if we see this, start to climb, we're already at about like the 75% mark. So I'm going to say this is probably going to prove to be another one of these instances where Coca-Cola making a new high while the rest of the market was struggling is going to be a negative sign for us. The volatility weighted put call ratio has returned back to its moving average. This is not necessarily a risk on signal. It tells us that the put call ratio is starting to normalize. Might be a liquidity issue as well that's causing it to resolve. But we're still well below the follow line, and so we use these in conjunction. So this is risk off until we see the S&P move back above about like the 56.75 range. The Fabian market timing model uses the 39-week moving average for the Dow, the S&P, and the Dow Utilities Index. The Dow Utility Index has been teasing us a little bit. All of them are below their moving average right now. This has a 80% win rate, and so this is risk off right now. And very, very few signals. You can see, this is going back to 1970. We have 22 signals that have been risk off. The Fisher-Coppock combination. So these alerts on every single screen. So the Fisher just so this uses 2 averages of the Fisher transform. So the Fisher transform's a little bit noisy. It's the Blue Mountain in the background. So I'm using a least squares moving average and then an average of the least squares moving average. That crossover is what signals the risk off event for us. And so that just triggered this week. It's confirmed by the weekly close, but I think it's pretty safe to say that we're going to close with this signaling risk off today. This is a very slow moving indicator, so we don't have a lot of instances of this as well. This also has 22 prior instances. The Coppock curve going below 0 has 20, and those have very high win rates. I'm taking this as a red because the Coppock is is pointed down so steeply, and it's already crossed over its monthly version of itself. And then the stock or the equity and commodity model. So this is not good because we've got when we look at the rotation of assets, we would like to see we would like to see the opportunity for treasuries to peak, then one last push in equities. We position ourselves into commodities and we take advantage of that. In Martin Pring's report, he was concerned that the underperformance in commodities will suggest that this is going to be a really muted opportunity. And so if you are positioned in commodities, just be aware of that and we probably want to take profits aggressively. But this is intra-month starting to give us a second signal where the spread between the rate of change of commodities and the rate of change of equities is too wide. So that's one of the three conditions for this to be risk off. So it's currently a yellow and not a red, but intra-month it's starting to flash a red. New highs versus new lows. So the cumulative number of new highs and new lows is below its 50-period moving average. And went over this one on the last call. It's a pretty strong indicator. We're also well below the 300 and this is a 350-day that I'm using here. So it's a 325-day moving average. When we lose that thing, that's a pretty steep downtrend. And then if it starts to give us a descending look, then the market is certainly risk off. But what's interesting here is the selling climax intraday has been over 10%. So the number of companies making a new low is exceeding 10%. When it gets to 20%, that's a sign for a temporary bounce. So you can see in the past when it goes above 20%, you're in proximity to like a nice like few percent move back up. So if that's something that anybody here takes advantage of, you probably want to be really fast with it and very tactical. I may or may not participate in something like that if we get to the 20% range, but I do expect that we'll see some bounces. But they're probably going to be sold into by the rest of the market unless there's some type of real positive catalyst of news that comes out. So this was this is the one of the indicators from the Larry Williams presentation or Dow award, and it's the extreme vulnerability. And this is now at its 129 days since we've seen an extreme low in net new lows, and that's the longest since 2008. And these have, there aren't terribly many instances of this, but it's preceded some of the more severe market downturns. Above 65 days is high risk, and you can see those have led to some steep sell-offs in the past. But yeah, and the selling climax is one of his as well.
Ben, what does it take to reset that indicator then? Because I see just a straight line up.
Yeah, it's and we see like it's the last time that we had it like that was 2015. So these have to get to we have to achieve a single day of less than 1% of companies making a new low. So it's like 0.325% of companies in the New York Stock Exchange make a new low in a given day, and that resets the indicator. Once it's made these like big extremes, that doesn't necessarily mean that we're out of the woods when it resets. you want to see it like, really bottom out. This tells you that the market's in a bottoming and then moving into an expansion. So once companies, once their stocks have really, really bottomed out, then they're pretty much never making new lows after that. Once you're back in a bull run, so the extreme low happens quite a bit during expansions, and less so towards tops. But yeah, look at 2008. It's pretty nasty. But afterwards, it resets, and then you're still not out of the woods. So it's really not a good risk on indicator. It just tells you that you're in proximity to potentially something pretty bad happening.
Oh, Ben, also, if I could add to that, actually, I just got into Larry Williams a lot the last couple months, and just kind of following the commercial traders. I don't know if that's something that you track or not, but I try to kind of keep an eye on that too. But I don't know if that's something you look at very much, but kind of something that's been interesting to me lately.
How do you use it?
So I'm still trying to figure it out, and I don't know how accurate it is, but I'm kind of stuck on his the Williams commercial or the WCI indicator. I don't know if they have one in TradingView. I literally just took and kind of from one of his books and kind of tried to I could share it with you sometime, whatever I created,
Yeah.
but he's trying to track the kind of general overall, like, are commercial players long or short. He kind of compares the last, I think 26 weeks was his thing, just seeing are they extremely long or extremely short, and then looking at overall open interest if it's extremely long, extremely short, and then kind of just using that as like maybe a potential. So it's like gold overall, commercial players are still relatively long, but open interest is going down. So it looks like maybe they're selling off some or something. I mean, it kind of lines up with a lot of the stuff you're saying. But to be honest with you, I don't know exactly, like just because they're extremely long doesn't necessarily mean anything. Just because they're extremely short doesn't necessarily mean anything. But it's just kind of an indicator of time to start playing with it. I am seeing like some places they're extremely short. I mean, like, well, yeah, QQQ and stuff or NASDAQ, they're down. They're not exactly super short, but they've definitely sold off a lot. So I would, but yeah, it's interesting to see how it kind of lines up with that other indicator. And I know he has a lot of indicators, so I'm not really
I've used it like a little bit. So I used this version of it that I recoded a little bit. But it's not something I've used a ton of. So like the green are the commercial hedgers, the red are the large traders. And so they're large enough to have to submit a commitment, a traders report. And then the small traders are the net, they're the remainder after you add those two up.
cool.
And they're so small they don't have to submit a commitment to traders report. So it's usually retail guys.
Larry's is like that, but instead, because that's like the actual data week to week, correct?
Yeah.
So Larry basically does that, but then he I guess normalizes it, and he takes the highest high, highest low of the last 26 to see, like, I mean, it looks like commercial players might have even bumped up the last week a little bit. I mean, they're still on the short side, it looks like. But I guess the big thing is like compared to the last, like, I don't know, he said 26 weeks. He keeps beating that into my head every time I read his stuff. But over the last 26 weeks, how short are they? Or because a lot of these, a lot of the commodities are just naturally short because they're selling.
Yeah.
Anyways, yeah, it's I don't know. That's just kind of interesting how it's that other indicator from him, I think, kind of lining up with some of the other stuff I've seen. So sorry, it was just kind of
No, that's great. And I haven't used it for much for equities, but yeah, this is interesting. So you've got like a switch between the commercial hedgers and and the large traders. Right? So
Yeah.
usually that's interesting when they switch positioning. These guys are, always in like a ratio to one another. And
Yeah.
then you've got the retail guys who are in most commodity trades are typically on the wrong end of it. There are some that where like Bitcoin, where the retail traders tend to be correct. Um, but yeah, it is. I've used it a little bit with like natural gas, gasoline futures, things like that. But I haven't really used it with equities. Bitcoin is interesting with it. Like you've got
Yeah, Bitcoin, I don't know how to use, I mean, the commercial players are, yeah, I don't understand it with Bitcoin. I think it's more I mean, commercials just hold it because they have to, because they're
yeah.
processing payment stuff, I think, right? Or,
Well, what's really interesting is like this is the only chart that looks like this with the commitment of traders report that I found, right? Like so you've got the retail traders and then the large traders that have to submit their CO2 report. Um and so they're behaving like the hedgers versus commercial in most commodities up until the 2021 high, and then the retail guys get nuked, and then it switches, and the rest of the path kind of looks normal for the relationship between commercial hedgers and large traders. But you're this is one where the small traders tend to be pretty accurate with Bitcoin, right? So they're buying when they pivot up and they start buying, it's starting to move up, and they start to exit up here at the end of 2024, and it hasn't really been small retail traders that are holding price up where it is right now.
yeah. Well, I think it'll be interesting, like, I mean, as the market's kind of crashing down, it'll be interesting to see if commercial players kind of start getting more involved. I mean, I don't know how much weight I'll place on it, but it seems like it would be it'll make me feel a lot better if I know some big guys are starting to put some money towards
Yeah,
it. But it could take months, because those guys will start buying at some point on the way down, and they'll be able to hold it a lot longer than I probably would want to.
yeah, exactly. Yeah, interesting. Yeah, I'm gonna take a look at that one later this afternoon. If you could send me what you have on it, that'd be awesome.
Yeah.
Yeah, good. And then on the momentum model, we've got a move into the bear zone on the RSI on the weekly, and that's not something that we have a great deal of on the weekly. I'm just gonna take a look at my Excel sheet real quick, see how many we had. So when we look at the momentum model for the weekly, that's going back to 1980. I've got 20 signals. So this is the 21st time in 45 years that we've got a risk off on this one. It's not terribly infrequent, but is that only on the month? No, that's on the weekly. Yeah, where where we've lost it for a full week. So now when we look at where the market's headed, so I see Johnny's question, is how does this compare to 2020? 2020 is interesting because it drew down so quickly, and you can see this is like kind of drawn out. This is taking like a real ABC kind of pattern, which is normal for a drawdown. We would see it like an ABC that would look typical, could come down to like this lower than this 5,000 range, with C being typically longer than A. But when we get into the 2020, that was such a fast and rapid move down. You've got your ABC, but it's like when the market corrects very, very quickly like this, really fast corrections, it likes to get the process over with quickly, and then the recovery starts much more steeply. So this is a nice like V shape. This one's more extended, 2022 we see was a very extended like 5-wave down. And so when we get into the current state, this has been much more extended than 2020 was, and is a bit more drawn out like 2022. The last 2 days are the most rapid of the descent, and whether that continues lower, we'll find out. But it's definitely it definitely looks more like one of the more extended moves down that or elongated corrective moves than a rapid drop. So these are each breadth indicators that look at long-term capitulation and short-term capitulation. And so, we said a couple weeks ago, we're tapping this like extreme low that we see in the short term that sometimes signals like the low of a move, and we're looking for like a low and then a higher low, and this hasn't made an extreme low on the short term, but it keeps getting below this 85 level, which is typically near the bottom of a short-term move, especially when it's accompanied by the long-term capitulation oscillator going below 95, and that it's had downside breakouts, but it's not gotten low enough to suggest that we're in market low territory, like we saw in 2023, October 2023. It gets down here into a low, and that signals the bottom for the market. So once we start to see long-term capitulation get below that threshold, then I'll start to feel comfortable that we're at a market bottom, and we can start looking for confirmation of a move up. Now, it might not make it all the way down there, but if it doesn't, what we're going to want to see is this kind of sequence on the short term, where you've got an extreme low on the short term and then a higher low into a recovery. And it's just it's telling us that it's just getting started. Right? So we already looked at this VIX one. I had this one in the chart last night. This uses the Williams R. So this is a Larry Williams indicator, and it's really similar to the stochastic oscillator. It uses the similar data points in a different order, and that's why it goes from 0 to a negative number. So I've got an 8-month, 18-month, and 24-month, and when the 8-month plummets below the 80 level, that's you've got two risk-off signals. Like either the 8-month goes below the negative 50 halfway point, while the 18-month goes to the halfway point, or the 8-month goes all the way below 80 by itself before the other two. And so these guys are all signaling risk off. Sometimes this thing is real late to the party, though. That's why I don't typically use it for risk off, but it's a really strong indicator for risk on. So once the 8-month recovers and goes back above negative 20, then and the 18-month and 24-month are upward sloping, then we've seen the low, and it's slow confirmation that we've seen the low. This is when I'm going to start putting cash back into the market and redeploying to risk. But you can see, even it's a slow moving indicator. It's pretty strong, pretty solid. But it's like you're getting whipsawed here. This in 2016, you're coming out net neutral. right? And then in 2020, it's signaling halfway through the move down, and then you're getting back in higher than you sold. So that's why I don't like this one as much, but it's good confirmational, and this one's confirming what we're all seeing in the market right now. It's a strong we've got strong momentum into a move down. And then let's take a look at like another so Powell was on today, and I think everybody knew that they wanted Powell to tell us more than he did, but he's pretty tight-lipped when he wants to be. So when we look at what everybody's wanted to know is the Fed going to do something in response to the drawdown in the market and what we're seeing on tariffs. But the Fed's job isn't to protect the stock market, even though sometimes they do bail it out. Their job is to protect the economy, and the economy is still in a state of expansion currently. But this is the effective Fed funds rate is the target rate that the Fed is using for interest rates for overnight interest. And then you've got the market rate for 2-year treasuries. And Tom McClellan posted something about this. It's something that a number of people have shared over the years, but the 2-year treasury and effective Fed funds rate move together. And that sometimes we hear that like the bond market's the smart market, but they get this wrong on occasion too. But typically the market rate for 2-year treasuries will lead or closely lag the movement in Fed funds. Usually it lags movements up because they're not convinced that the Fed is going to continue raising rates, and then it leads the Fed down. And so the light blue is the same thing offset by 40 weeks. And then you've got the moving average with it. And so we can see when we get this crossover of the 2-year rate, the market rate for 2-year treasuries falling below its 40-week moving average and its 40-week shadow, you're now headed downward, and the Fed is going to follow with interest rates lower. Especially when we take a look at the spread between them, which is down here in the bottom in white. You've got the spread falling and then not recovering back above zero. That's when the Fed starts cutting, right? So the market started to come back up to the target Fed funds rate and then decided it's not going to, and it's coming back down. And that's when the Fed's going to have to chase rates lower. And in the instances where that's happened, that has been the rollover for the stock market as well. And that's what we're seeing right now is the spread between the 2-year market rate and effective Fed funds rate has plummeted below zero, tried to recover, failed at neutral, and now it's negative and back below its moving average. And we would expect that to proceed a move lower in stocks like it has historically. So I'm not one to predict interest rates, but this suggests to me that we will see an interest rate decision, maybe even an emergency rate cut if this doesn't, unless this gets back above zero and the market starts selling off treasuries on its own, we could expect to see a Fed rate cut soon. And then so taking a look at my watch list and filtering it for things that have multiple bullish signals right now, this is nasty. Like these are not bullish assets to see on this list. So you've got your bear ETFs, your treasuries, the Swiss franc ETF, more treasury ETFs, the leverage long VIX ETF, short S&P, and then the VIX. You get some weird things that show up in here. You've got like your 3-month VIX and regular VIX, bearish gold, bearish energy, and then the interest rate spreads are both have multiple bullish signals right now. This is probably the only like bullish, actual bullish asset that I see on the entire list is RKT. So let's take a look at that. So, and it's got a pretty big day. It's got a news event with it. Interesting. So yeah, not much screening on as bullish for us right now. And even though we've got a really strong upward candle from RKT, I'm not sold on this. This could be like an ABC move up into the 0.786. But we'd want to see a close. Usually a couple closes above the 382 are good. I'd like to see it like have a full candle close above the 382, maybe a retest, see it get above the 786 and retest it to feel more strongly about it. But you've got like kind of a rounded base with it. So it's not awful, but yeah, there's really not much in the market that looks strong right now. Let's see it on the daily. It's looking okay, but yeah, it's a really kind of bearish look for the market. And then looking at the high yield rate spread, so when the high yield rate spread is surging like this, equities will typically move in the other direction. It's when the correlation coefficient between the two starts to move into positive territory, neutral towards positive. That tells us that one of the two of them is going to pick a direction and mean revert. When the correlation coefficient is negative and they're each moving in a direction opposite of one another, then we should expect continuation. And in this case, that continuation is down for equities and greater demand for credit. And then if we look at like the liquidity cycle, this is very busy, so I apologize for that. We'll look at it for S&P and the 10-year and commodities. And so this is taking the Chinese 10-year rate divided by the US dollar index divided by the high yield rate spread. And so this is our proxy for demand, availability, cost, and demand for liquidity. And the 5% threshold, 0.05% threshold is where we get into like some really adverse territory for credit. And these represent credit shocks. And so you've got the liquidity cycle and equities should be correlated with one another. They should have a high positive correlation. When they slip into negative, that's when they're diverging from one another. And you can see, liquidity is starting to The liquidity cycle is starting to move in a descending fashion in 2022 as the Fed is tightening, and equities are slow to respond. And so you've got, the movement in the correlation coefficient tells us that the market is slow to respond to liquidity leaving the system. All of these vertical lines are Fibonacci timelines that I anchor to the beginning of a credit shock. These things tend to have like a market memory to them. And so you can see like, the start of a credit shock and clusters of them, and you get volatility, within a time span after they occur. It makes it a little bit noisy, but the most important thing to understand is that, we had liquidity was moving upward, the market was moving up with the liquidity cycle rolled over, and it's leading the market down, leading the market lower. So you've got, if you were to look at this as like an ABC movement down, we're just starting like A, right? So until this recovers, and both of them are actually, what would be ideal is if the liquidity cycle moves up in advance of the market moving up, then we could front run it a little bit. Still be high risk, but it's pretty consistent liquidity cycle in a downtrend, and then equities respond at a later time and they move down. And that's the lowest that it's been since 2022. But actually is kind of close to where 2022 bottomed. So if this improves, that'll be good news. So with that, do you guys have questions? Anything that we want to take a look at together?
Hey, Ben, it's Brian. Quick question on parking cash. Even the last few weeks, AAA rated bonds aren't totally safe. Obviously, short government. SKWD it is, but it's pretty boring. I've looked at like selling really far out of the money puts to just get some income. Not giving financial advice. Where are you parking cash at this time?
I move a lot into to treasuries, but I did that through most of the second half of 2024. Things that I sold, I would split between gold and treasuries. Yeah, I think anything that's not already parked in bonds and treasuries, given that Martin Pring schedule that I shared earlier, where we're entering the phase where we take profit on bonds and treasuries. I'm just not as comfortable there. So that's a tough call. I think I'm probably just going to leave funds in high yield interest accounts and things like that until they're ready to be deployed back in the market. But if you do use seasonality's been a little bit goofy this year, but if you were to look at like covered call strategies or anything like that, covered put strategies, something like that's got like a really consistent seasonal cycle to it, I'll play around with sometimes. So I've got some covered calls that I sold on Procter & Gamble, and I'm banking on this being like, a lot of times we see the market draw down like this. Even when it's pretty severe, its moves can run out within like the downtrend can take like 2 to 3 months. So I'm thinking that by June, I'm safe selling some covered calls on Procter & Gamble into June expiration, because Procter & Gamble tends to start going back down in June, and I'm selling out of the money. So I did some of those. I have a lot of Broadcom still in my portfolio. I just have it at such a low cost basis, and so I sold some July covered calls on those. And so I look for a month that, like, if I'm going to sell a covered call, I look for a month where the expiration is going to be aligning to a month that the equity typically doesn't do well. And And then I put in so like I put in a buy to close order that is 90% in the profit. And when you do that, then you can like if you were to do weeklies and you sell a covered call that's 90% of the profit, or you buy to close when it's 90% of the profit, then you can sell your next weekly more quickly and in advance of some of the theta decay. But that's a lot, but I'm actually pretty unsophisticated when it comes to options trading.
Thanks, Ben.
Yeah, have you looked at anything else to park? Cash?
No, I mean, I was involved in like some CLO, JBBB, JAA, but even those just like they still take a hit. So if you're leaving it parked and things like that, it still has an opportunity to kind of erode your capital. And so just looking for alternatives to short-term T-bills kind of thing.
Yeah. Yeah, it's even on the short-term side, like do the leveraged ones pay a good dividend? Can't remember. Just gonna look real quick.
Not even to chase huge yield, just something better than 4%,
Yeah.
which is pretty good, I know, but
Yeah, like even the leverage one pays a much smaller dividend. It's like only 3% yield. But yeah, if playing so I'll bring up my watch list of a few things that do look pretty good. Yeah, it's not a real awesome watch list. Um, I shared this one a few weeks ago. This one does not pay anything, I don't think. No. But this is a domestic leasing um, company, and it tends to do well in downturns. It tends to have relative strength in downturns to the broader market. If credit is tightening, leasing companies, may and companies are worried about making large capex, and individuals are. This could be a good opportunity. Insurance can do well. I know Aaron's big on KNSL. Insurance can do well late in cycles, but it also tends to correct really heavily when the market gets nasty. Um, the Man, I'm gonna leave this one alone. Take that one off the list. So the managed health names have done pretty well. Oscar's one that's super beaten down. And if we take a look at it, it's got a pretty evident cycle to it. And so this would call for us to be in proximity to a cycle low. And this is a 1/4 harmonic from the larger basing pattern. So this could be, a handle pattern to a cup formation in a beaten down name. And if this is a sector that the market is looking to migrate into to shield themselves from tariff exposure, that could be a good opportunity. UNH is, obviously this one's done pretty poorly. So when we look at the sentiment cycle, like this is how we want to use the sentiment cycle, is to look for companies that have gone through their subtle warning, their overt warning. We've got the panic, the wall of worry, the aversion. Sometimes the aversion comes down lower and it's not a higher low. So you've come down into aversion, and this is very likely denial. Like people still don't like this name, right? So if it gets back above, like say like 550, 555, it's likely that we see this, challenge for another new high if people are looking to hide out and protect themselves from tariff exposure. and then it's which puts it back in in a position to achieve this proportionally measured range that that it failed to hit in the past. So this is one that looks like it's approaching the area that we would like to see for the sentiment cycle. And then you've got ELV, Elevance Health, is another one. And so if we look at the sentiment cycle, you've got your enthusiasm phase up here. Then your subtle and overt warnings happen pretty quickly. It erodes, you get your panic. You've got your anxiety, your wall of worry and despair, right? And this is likely your aversion and your denial phase. And denial at the top of a island bottom breakout is really common. Now, the safest way to do an island bottom breakout, like the most conservative, is to let it come up and then come back down and retest. But if there are very few names that that the market finds safe to be in right now, I'd keep be really cautious on it and play it conservatively. But this could be a decent opportunity. The ones up here are ones that I'm in right now. But I'm taking like profit on this short semiconductor ETF. I don't like to carry these through the weekend. I'll probably take profit on the high beta short as well. I might hang on to the junior gold miner bear fund and see if it tests one of these higher VWAPs. But these are things that might be opportunities. Then you've got the treasury ETFs. Martin Pring suggested that around like the 100 mark might be where we could see it fatigue and start to roll over. Another insurance name, Skyward Specialty Insurance, that has not met its full target yet. I'm not in this one because it has closed below what I would have targeted for a stop. So we'll see how this plays out. Monster, I think, is probably a pretty safe name from the tariff war. See if I have more than one. I just did the one GAN box for it. So if so you've got a really nice breakout on the volatility weighted MACD. I think the on balance volume is very strong for this move. So a retrace into into this like 58, 57 level should bounce back up into the center of the GAN box. But what we're looking for is once we get past this descending 45-degree line in the center of the box, we want this thing to either get like back above 60 before the middle of May, or retest like the 57, 58 range after the middle of May. And that should be positioned for a nice move into the upper range, probably by like the July timeframe. But this is I'm just trying to comb through and find some names that I think will probably be companies that are insulated from downturn, from credit tightening, from international pressures, things like that. Xcel Energy looks poised to if we get a break above this like 72 level, should complete its measured range. Energy names the market probably comes back around to. Waste management, I think, is looks like it's, because it got almost up to the 1.618, probably corrects here. And if it does complete like a classic correction, so it comes down to the 382, if it bounces back up to 232 and then down to say like 220, I would personally get involved there, but be aware that like it looks like a head and shoulders pattern. And if it doesn't bounce off the 220 level, then it could get into the lower 200s. But this is a name that, throughout the remainder of the year should continue to do well. This shouldn't. I'm not thinking that it's going to have a lot of tariff impact to waste management. A couple of names that I heard suggested the other day, Huntington is looking pretty awful today, but there's going to be a push for shipbuilding in the U.S. The materials that they need in their supply chain don't appear to be they appear to be excluded from tariffs, and so their customer is not going anywhere, and their supply chain um, uh, should be the same. So I'm thinking that this one, once it finds a bottom, is probably a safe place to be. But um, none of this is stuff that we need to try to jump on anytime soon. I think we let things normalize and settle first. Palantir is another one that I think the market's going to be pretty sour on Palantir because it's a high beta stock and um, a high PE ratio type of play. But once this maybe comes down to like the upper 60s, mid to upper 60s, um, this should be a pretty decent opportunity. They don't have tariff impact. They're not allowed to sell outside of the US. And the government's their only customer or their primary customer. So I'm thinking this one is one that the market might overlook and show some denial. And remember, we want to look for something that's going to come down here, show us that despair phase, come up to a little bit of anxiety and retest, and then we want to I'm going to look to participate after I see it complete this type of activity down here. Costco is one that I'm always looking at Costco, but it's possible that we see a move down to like the 840 level with Costco. If this area holds a support, I'm going to look to see how you've got like kind of a volatility squeeze in between the upper AVWAP and the lower. I'm going to look for it to pick a path before I do anything. So it's either going to break below this squeeze in between the AVWAPs and come down to a support area, or it's going to break above the 786 and the upper red AVWAP. I'm going to look for it to break above that, retest it as support. I would get involved with it, add to my position in it on either of those scenarios, or even both of them. And then let's take I shared this the other day, but when we look at things that are in a downtrend, so a lot of us go long on positions, and not many people that I interact with are heavy short sellers. It just doesn't resonate with us as easily. But when something's in a downtrend, it can be harder to anticipate. So inverting the chart helps us to think about it in our natural state a bit more clearly. And so when we look at the inverted S&P ETF, this looks like a bullish setup that I would enter a trade in, right? So you've got this is almost like William O'Neill's high and tight flag. It's a 10% move into a retrace to an AVWAP, then it bounces off of that. So that you would set that up as like a measured move, and we just made that move today. As SPY comes down to 510, 509. So that's hitting a full measured target that might even be due for a corrective corrective move in a downtrend would be a move upward for us. But when you see something like this inverted, it tells us that the story has changed. We've got like a rounded base, and it looks like a bullish setup that we would find elsewhere in the market. The volume that we saw on the S&P the other day in the opening hour was on SPY was the the highest opening hour that I've seen in there were like 40 occurrences, and half of those were movements down. Of those, it was among the top two. So that's a pretty big deal. When we see odd things like that, it tells us that the market is really starting to change its mind about the opportunities in front of it. So today's volume also really high, and also pretty high at the open. Actually a little bit higher at the open. So this would be, the number three highest, 3 and 4 highest intraday volume that we've seen on record for SPY on an hourly basis into this violent sell-off. Looking at it just on the just at the S&P itself, it's fallen out of this GAN box, so that I'm using these 144 period GAN boxes to navigate through the trend. And so now that it's broken below this GAN box, that tells me that that's my strongest signal that that we've got an actual change in trend, and not just not just a corrective movement. And so I'll have to start to look at whether I need to use a new GAN timeline and remeasure out on a different proportion to try to find our levels. But we've come down below the 1.618, selling off a bit further than I realized it was, and starting to come down towards the green AVWAP that anchors all the way back to the 2022 low. So that's the next AVWAP that's been put in play. That's ugly. Yeah, what questions or what other things are you guys seeing? So once we've got the new low like this, that's where the next green AVWAP has to move to. And as we start to get into this for now, as we start to get into a recovery, we'll look for support at one of these fib levels, and for it to we're likely going to run into resistance at the overhead anchored volume weighted averages, and it'll start to do what we saw in that Costco chart where it's kind of volleying in between, and we're going to look for it to pick a path. Not comfortable trying to pick a bottom and rush into a bottom in a market selling off this violently. I want to try to buy on strength and not into weakness. Yeah. Anything else from you guys? Stunned silence.
But this was great. Thank you very much.
You're welcome. Now you know what? Just for fun, let's see what the heat map looks like. That is, whew, that's ugly. Well, listen, I think no way around it. This is not it's not pleasant to see the market come down like this. I hope that the indicators were enough to help us get some folks into position to take advantage of it once it does calm down and settle out. But the key from here on out is that we just stay really composed and wait for evidence of a completed move before we start to try to get back in and pick an uptrend. But we'll have to keep a tight eye on it, and I'll send updates as I see them. But as you guys have questions or see things, feel free to reach out. If you know of people that are concerned that would benefit from any of this type of stuff, let me know. I'm happy to share with anybody who's interested.
Thank you, Ben.
All right. Thanks, guys. Yeah, appreciate the time today, and thanks for your participation. Awesome. All right, guys. Have a good weekend.
You too.
You
Thank
too.
you. You too.